What is VAT or value added tax? It is a type of consumption tax that is charged on a product whenever value is added at a stage of production and at final sale. Or one could simply say it is the tax charged by the government when value is added. VAT is proportional to the price charged for the goods and services. Value-added taxation is based on a taxpayer's consumption of goods rather than his income. Let us consider an example to see how VAT works. A supplier sells dates to an industry owner for 1,050 dirhams. 1,000 dirhams is his income and he pays a VAT of 5%, which is 50 dirhams to the government. The industry owner then makes date syrup and packs it with his brand name. He then sells it to the distributor for a price of 2,100 dirhams. 2,000 dirhams is his income and 100 dirhams is the VAT charged. He collects 100 dirhams from the distributor and reclaims 50 dirhams paid to the supplier. So he deposits 50 dirhams to the tax authority. The distributor sells the date syrup to the retailer for 3,150 dirhams. 3,000 dirhams is his income, plus 150 dirhams is the 5% VAT. So the distributor collected 150 dirhams VAT from the retailer and reclaims 100 dirhams he paid to the industry owner. So he pays 50 dirhams to the government. The retailer finally sells the date syrup to customers for 4,200 dirhams. He earns 4,000 dirhams and charges VAT of 5%, which is 200 dirhams. He reclaims the 150 dirhams he paid to the distributor. So in summary, he pays 50 dirhams to the tax authority. In this entire supply chain, the tax authority collected 200 dirhams. With VAT, the consumer has paid and the government has received. The intermediate businesses have not incurred any tax themselves. Their obligation is limited to assuming the necessary paperwork in order to pass on to the government the difference between what they have collected in VAT and what they have spent in VAT. On the other hand, they incur increased accounting costs for collecting the tax, which has to be borne by them.